Every single day, an estimated $7.5 trillion changes hands across the massive global foreign exchange market. This daily turnover is 10 times the size of all the world's equity markets combined. To put that in perspective, the value traded here every 24 hours is 60 times the entire daily GDP of the United States. It is easy to assume this volume is driven by the visible economy, like tourists exchanging cash at local kiosks or global corporations buying currency to pay for a new factory overseas. Non-financial customers actually account for just 9% of this volume. The other 91% is entirely interbank and institutional, a closed loop of banks and financial firms trading with one another. This reveals a disconnect between theory and practice. Standard economics says exchange rates reflect long-term trade balances and interest rates. If those macro factors move at a glacial pace, we have to look at how these institutions are extracting fortunes on a minute-by-minute basis. Unlike a centralized stock exchange, the currency market has no physical headquarters. It is a decentralized network of worldwide institutions operating 24 hours a day across hubs like London, markets in Tokyo, and New York. On this network, institutional dealers act as market makers. They provide a constant two-way quote, a bid price to buy a currency and an ask price to sell it. The difference between that bid and ask is the spread, the institutional profit margin. In this market, price movements are measured in pips, a unit representing just 1/100th of a cent. On this trading platform, the euro to dollar quote shows a bid ending in 97 and an ask ending in 98. That tiny gap is exactly 1 pip. Because the profit margins on a single trade are limited to these microscopic fractions of a penny, making billions of dollars requires discovering guaranteed mathematical pricing mistakes and executing them at massive volume. This is where triangular arbitrage comes in. This strategy exploits temporary mathematical misalignments in the cross rates between 3 different currencies, in this case, the dollar, the yen, and the British pound. First, a trader takes a $1 million loan and immediately sells those dollars to buy Japanese yen at a slightly mispriced rate, yielding roughly 92.5 million yen. They take that entire sum of yen and instantly use it to buy British pounds, netting just over 647,000 pounds. Finally, they sell those British pounds to buy back US dollars, completing the cycle. After paying back the initial $1 million loan, the trader is left with over $14,000 in risk-free profit from a single loop. But the strategy is only risk-free if all 3 transactions happen simultaneously. If the market has even a second to react, the pricing anomaly will vanish, turning a guaranteed profit into a massive loss. In the early 1990s, a star human trader completed roughly 1 transaction every 67 seconds. At that speed, capturing these fleeting pricing gaps was nearly impossible. The transition to electronic platforms like EBS and Bloomberg removed the human from the execution loop. Trading shifted from the shouting of phone rooms to the silent processing of global data networks. Today, high-frequency algorithms endlessly scan millions of global cross rates. They are designed to spot a triangular arbitrage opportunity the moment it appears. The machine completes the entire multi-currency triangle in fractions of a millisecond, siphoning out the profit before a human can even perceive the opportunity. This automated pursuit of profit is so pervasive that electronic execution now accounts for up to 90% of all interbank trading. This creates an unintended byproduct. By relentlessly exploiting every pricing anomaly, these algorithms are effectively doing the market's math. They correct the pricing mistakes as fast as they find them. This technological war has compressed the gap between buying and selling prices, the bid-ask spread, down to a microscopic level. This constant correction ensures that currencies are perfectly aligned across the entire global network. For the world economy, it means capital can move across borders with almost zero friction, creating the most liquid and efficient market in history. In this environment, the scale of your capital is secondary. The highest returns go to whichever machine can observe the present milliseconds before the rest of the network.